David, let me begin with you. You say you think the Fed will raise rates sooner than they are currently suggesting. What combines to cause them to do that?
Here's something.
And how much sooner would that actually be?
Yeah, so let's put that in perspective. Sooner than they're currently suggesting, we think is still years away. So they were originally talking about 24, 23. The markets are thinking sometime late in 22. We still think that's reasonable. They're not going to be doing anything, we don't think, this year. And very importantly, in today's news, no news is good news. Not changing anything, not saying anything new, we think is very bullish. Not going to impact the market today, but we do think it allows the market to continue to trend higher over the next few weeks.
Michelle, talk to us a little bit about that. Those numbers that Rick Santelli was mentioning. You've got 8 million jobs going wanting right now. There are 8 million job postings, so says Rick, and roughly 9 million or more people, fewer people employed now than there were a year ago. How do you join those two numbers? Talk me through that seeming conundrum.
Sure. So I think it's this idea that there's a bit of a paradox in terms of the fact that there's a lot of job openings out there. You can see that from the Small Business Confidence Survey, the NFIB survey that has record high numbers of job openings. And yet we know that there's a lot of people sitting that are still considered unemployed, and even more that have dropped out of the labor force that have not yet come back in. So I think it's just a bit of tension right now in the labor market. Perhaps there's some skill mismatch. Perhaps there's some challenges in terms of getting people to fully re-engage, given that the concerns over the pandemic are still ongoing, childcare concerns, unemployment insurance. There's a lot of factors. And just from skimming at the minutes just now, it looks like the Fed is quite aware of this as well, and anticipating that these kind of frictions in the economy are going to show through over the next several months.
David Katz, I think the key phrase right now as we look at the markets, which are about 100 points lower than they were before these minutes came out, the 10-year yield moving higher. There's the following sentence. A number of participants suggested that if the economy continued to make rapid progress towards the committee's goals, it might be appropriate at some point in upcoming meetings to begin discussing a plan for adjusting the pace of asset purchases. So, yes, a lot of qualifiers there, David, but is that what is upsetting markets right now?
That would seem to make sense. The market right now is being strong based on this tremendous liquidity. Everybody's fearful when that liquidity starts to go away. So those comments indicate that at some point the Fed is going to talk about, at some point, taking some of those liquidities away. So we think the market's just very sensitive to that. We don't think the comments that they make today, based on what you're saying, is really going to change the direction of the market. The market on a day-to-day basis can get spooked. You already had a sell-off and you just have negativity today. We don't think that there's going to be a change in direction. We think overall the news is generally positive. The economy is doing better, and the Fed is still keeping rates low for quite some time.
Shepard Smith here. Thanks for watching CNBC on YouTube.